Have you ever felt like your hard-earned money is losing its value due to rising prices? Are you worried that your investments won't keep up with inflation and you won't be able to achieve your financial goals? Do you wonder how you can protect your savings and investments from the effects of inflation? If you answered yes to any of these questions, then it's time to learn about how investing during inflation can help you stay ahead of the game. In this video, we will explore the investment strategies of one of the most successful investors of all time, Warren Buffett, and learn how to invest wisely even during times of high inflation. But before we get started, we just want to take a moment to thank you for choosing to spend your time with us. At Luxo-Life, we're committed to providing you with valuable insights and strategies to help you achieve success in all areas of your life. If you find this video helpful, be sure to give it a thumbs up and hit that subscribe button for more great content. Now let's talk about investing during times of high inflation. It can be a real challenge to make your money grow when prices are constantly rising. But thankfully, we can look to Warren Buffett for guidance. In this video, we'll explore some of Buffett's investment strategies and take a closer look at his past annual letters to see how he suggests we invest during inflationary periods. So if you're ready to learn how to stay on target even when the economy is tough, then let's dive right in. Let's start with the basics. Inflation is when prices of things like groceries, gas, and rent go up over time. Investing is when you put your money into things like stocks, bonds, or real estate to make more money. The tricky part is that inflation can actually decrease the value of your money over time. That's why it's important to think about inflation when you're deciding how to invest your money. You'll want to make sure that your investments are keeping up with or even beating the rate of inflation so you can still afford the things you need in the future. Investing is all about getting more money back in the future, right? But when we factor in inflation, it's more like we're sacrificing some of our buying power now so that we can have more in the future. For example, instead of buying 10 burgers today, we might invest that money in hopes of being able to buy 20 burgers in the future. It's important to remember that when we invest, we're looking for our real return, which takes inflation into account. Even if our investment looks good on paper, if inflation is high, our real return could actually be zero. So, it's crucial to think about our buying power over time and make investment decisions that can keep up with or beat the rate of inflation. This is what Warren Buffett pointed out in his annual letters to shareholders in 1979, where he highlighted the impact of inflation on investing. He mentioned how, a few years ago, a company could assure its owners of a very successful actual investment return if it compounded its per-share net worth at 20% yearly. However, the likelihood of such a conclusion was dwindling because whether a company's internal operating performance would result in profitable investment returns would ultimately depend on the inflation rate and individual tax rates. Buffett emphasized that the goal of investing should be able to achieve a reasonable gain in purchasing power from funds committed. Buffett also drew parallels between traditional financial instruments such as savings bonds, savings accounts, and treasury notes, and businesses that earn a high return on capital. He argued that just as inflation had transformed these financial instruments into investments that erode purchasing power, high returns on capital could produce a negative real return for their owners under inflationary conditions. In other words, if the rate of inflation is higher than the rate of return on an investment, the investor's purchasing power will decrease, resulting in a negative real return. Overall, Buffett's statement highlights the importance of considering inflation when making investment decisions. As investors, we need to be mindful of inflation and ensure that our investments can keep up with or even exceed the rate of inflation to achieve a positive real return. Moreover, Warren Buffett's concept of the investor's misery index is a helpful way of understanding how inflation and taxes can impact your investment returns. Let's break it down a little bit more. The inflation rate represents the annual loss of purchasing power of your money. In other words, if the inflation rate is 3%, then the amount of goods and services you could buy with $100 this year will cost you $103 next year. So, if your investment return is less than the inflation rate, then you're actually losing purchasing power. On top of that, taxes can also eat into your investment returns. When you receive dividends from a company you invest in, you have to pay income tax on that money. And if you sell your shares of that company at a profit, you'll owe capital gains tax on the earnings. These taxes can add up and significantly reduce your real return. When you combine the inflation rate with a percentage of capital that you have to pay in taxes on your investment returns, you get what Buffett calls the investor's misery index. If this index is higher than the rate of return of your investment, then you're losing purchasing power and your real return is negative. So, it's important to not only consider the potential return on an investment, but also the impact of inflation and taxes. If we can find investments that not only beat inflation, but also generate a positive real return after taxes, we can help ensure our money is working hard for us and maintaining its purchasing power over time. In addition, we all know that inflation can also be a challenging time for businesses, as it can erode their purchasing power too. Let me explain it to you in more detail. Businesses need to buy various things like raw materials, equipment, and other resources to keep their operations running smoothly. Imagine you run a bakery and you need to buy ingredients like flour, sugar, and butter to make your delicious cakes and pastries. Now let's say there's inflation and the prices of those ingredients start to go up. So even though you're making the same number of cakes and pastries as before, you pay more for the ingredients. This means that your profits will decrease, or you might even have to raise your prices to make up for the higher costs. And if your customers are also feeling the effects of inflation, they might not be able to afford your higher prices, and you could end up losing business. It's a tricky situation for both you as a business owner and your customers. Honestly, inflation isn't just bad news for us as individual investors. As I've said, it can also hit businesses hard. It's because rising inflation drives up interest rates, which makes it tougher for companies to borrow money or pay back existing loans. And this can make it more challenging for us as investors to find those winning stocks that we need to grow our money over time. So, the golden question here is, what should we do to protect ourselves from inflation and interest rate risk? Share your thoughts and ideas in the comments below so we can all learn and grow together. Going back in 1981, Warren Buffett wrote in his annual letter to shareholders about the types of businesses that tend to do well in high inflation periods. The first characteristic is the ability to increase prices without losing market share or unit volume. Essentially, this means that businesses can raise prices without customers turning into competitors, are better positioned to weather inflationary periods. The second characteristic is the ability to handle large increases in business volume without requiring significant additional investment. This means that businesses with a scalable model that can handle growth without requiring massive capital expenditures are better suited to survive in inflationary environments. By focusing on these companies with these two characteristics, Buffett believed that investors could identify businesses that were more likely to succeed and provide strong returns even in difficult economic conditions. Seems a little hard to understand. Let's put it this way. Let's say that you own a restaurant that specializes in pizza. If you buy the ingredients to make your pizzas at a low price, but then inflation causes the cost of these ingredients to increase, you could choose to pass on some of these costs to your customers by raising the prices on your pizzas. However, if your prices are already high, your customers may decide to go elsewhere for their pizza fix. In this case, your business may lose market share or volume. On the other hand, if your prices are still competitive and your pizzas are still in demand, even with a price increase, you may be able to maintain your market share and volume while also offsetting the increased costs of your ingredients. This is an example of passing on costs, and it's one of the characteristics that Buffett identified as being important for business that can thrive in an inflationary environment. Finally, Warren Buffett has one more piece of advice for those looking for a great investment strategy during periods of inflation. As we know, investing in the stock market can be quite challenging during these times. So, what's Buffett's advice? Stay tuned and find out. Don't forget to comment "I'm excited" in the comment section, and let's make this video even more engaging. Going back, Buffett believes that inflation can be a tricky thing to navigate, and it's like an invisible tax that not many people really understand. He recommends that the best way to protect yourself from inflation is to focus on improving your own skills and talent, because if you increase your value in your job or profession, they can't take it away from you. Another way to protect yourself is to invest in a good business which can maintain your purchasing power no matter what happens to the currency. In other words, if you can find a business that has the ability to raise prices without losing customers and can handle large increases in demand without requiring a lot of additional capital, then that business can be a good investment even during times of high inflation. And that's it for today's video. Luxo lovers, we want you to focus on improving your skills and talent. Inflation can eat away at the value of your money, but if you increase your own earning power, you'll be able to maintain your purchasing power even if the value of your currency declines. So try to learn new things and develop your talent to become more valuable in your profession or activities. Also, consider investing in a good business, as it can be a great passive investment that helps you maintain your purchasing power over time. Remember, the key to thriving in times of inflation is to keep growing and learning. I hope this video helped you to stay on target even when the economy is tough. Don't forget to leave a like and comment, and if you're new, hit subscribe for more awesome videos. See you in the next one.